right now we're going to turn to a piece of estate planning and financial planning that becomes very crucial, and that is risk and risk management. We have financial risk, we have market risk, we have economic risk, we have volatility, but at the end of the day, we have life risk. What if life is not the life that we are projecting out? What if we don't reach those years where we have all of that wealth accumulation? How do we put in place sources of liquidity and payments for taxes and other uses? And for that, we're going to turn to Lee Slavutin. Lee has decades in the insurance planning industry. He is also a licensed physician, or a physician, and surgical pathology in Australia. Before coming to the States, he serves high net worth individuals. He works with a number of advisors, and we welcome Lee to teach us and walk us through the life insurance options in today's marketplace. Lee. Lee is getting mic'd up.
Thank you.
You have the slide change.
Yes. Yeah, I'll get it. Thank you. Okay, let me get started here. Oh, I've got the screen here. What am I doing? Okay. Okay, so we're going to cover today 5 subjects, a couple of things on basic planning that I think it's always important to remember, the increased lifetime gifts that have been discussed, but particularly with regard to life insurance, gift tax valuation when you transfer a policy from an individual to a trust, for example. It's become important. It was a recent tax court case. Buy-sell, of course, is now very, very much an important topic because of the Supreme Court decision in Connelly, and then a few minutes on split dollars. So let's get started. You know, I always like to say, and I've been doing this a long time. I remember in the early 90s, 2 or 3 major life insurance companies went out of business. And I learned from that experience that the most important thing, and it's not just my opinion, it's actually the opinion of many people, when you're buying insurance is not price. The most important thing when you're buying insurance is safety and strength of the carrier, because you're buying it for a long time. You're not buying it for 3 years, you're buying it for 30 years or 40 years, or some of our clients now, believe it or not, have lived beyond age 100. And so it's a very long-term commitment. So I say to people, when you're buying insurance, think about it the same way as you would if you were buying a parachute. You don't buy parachutes on price. You don't go to a cardiac surgeon and say, I want the cheapest cardiac surgeon. You want the best cardiac surgeon. You want the safest life insurance companies. And with regard to choosing a company, one of the initial screening tools that we use is the Comdex score. And the Comdex score is basically a composite of all the financial ratings. The highest you can get is 100. It's interesting that the top 50 companies are all 94 or higher. The top 50 life insurance companies all have a score of 94 out of 100, 94 or higher. So why would you go to anyone below 94? Generally, you wouldn't. There is one exception. When we have clients with a problem medically in getting underwriting, we will compromise on that score. Maybe we'll go down to 90, but not below 85, because we want to try to find a decent carrier with a reasonable price for that particular client. But in general, we want very, very strong companies. If you want to get the Comdex score, don't try to do it on the internet because they're usually out of date. You really should work with the agent or broker, because we as agents, brokers, we have access to this information through the carriers we represent. So we can get you that information. Whoever you're working with can get you the Comdex score. So now the second basic thing I always want to remind people about regarding life insurance is term insurance conversion options. Term insurance is a wonderful product for young people who need a large amount of coverage. You know, you have a client who's in their 30s or 40s, they're making a very good income, they need $3, $4, $5, $6 million of life insurance. They need to have enough life insurance to replace their income. That's how you determine how much. They need to have enough life insurance to replace their after-tax cash flow. So if they're earning $400,000 a year and their after-tax cash flow is $200,000, you need to buy probably about $4 or $5 million of insurance to replace that cash flow. Roughly 20 to 30 times after-tax cash flow is the amount of insurance, depending on the age. It's not $1 million. You can't get much money from $1 million of life insurance. Get about $30,000 or $40,000 a year. You can't pay tuition with that in New York. So most of our clients are not buying $1 million, they're buying $3, $4, $5, $6, $7 million of life insurance. And when they're young and they can't afford to spend a lot of money on premium, term insurance is a wonderful solution. It's very inexpensive, 20 or 30-year term. Now, with term insurance, you have to look, besides the financial strength of the company, which we just discussed, you have to look at the conversion option. That is, can I convert that term insurance to a permanent, like a whole life or a universal life policy? Can I do it any time? If it's a 20-year policy, am I limited to just the first 10 years? That's not good. Can I convert to any kind of life insurance? Whole life, universal, variable. Am I restricted? Some kind of companies do restrict you. I don't want that term insurance. And then number 3, can I do a partial conversion? If I have $5 million of insurance, can I convert $1 million this year to whole life and do another $1 million a few years later? That's a nice option to have. So now the exemption, we know the numbers. In terms of what the exemption limits are. They're going up to almost 14 million next year. And we were worried about the sunset. I think that now is probably unlikely. I mean, I don't know for sure, obviously, but I would bet that the sunset will not happen, that we will get an extension of these provisions beyond 2025, and so we will not have to do it by the end of next year, but that doesn't mean I wouldn't do it. If I have a client who's in the right situation to make the gift, I would not delay it. Because if I'm wrong and other people are wrong and there is a sunset, then we're going to get caught. And remember, you can't wait till the end of 2025 to make the gift, because if you're making a gift of real estate or business interest, it takes months to get an appraisal. Nathan can tell you, it's not something that you do overnight. So you need months and months to get the proper appraisal done on certain assets. So the best time to do the gift, if you have the right client, is now. Even though we think the sunset will be extended, I wouldn't wait if you have the right client. Now, in terms of insurance, let's take a look at an example. Here's a client who wants to buy a large amount of insurance. They want to take advantage of the gift tax exemption. They want to pre-fund all the premiums. In this example, he wants or she wants to make a $2 million gift to the trust. Here's the question I want you to remember about this particular strategy. When you're making a gift, a large gift to an insurance trust to buy insurance, the question you have to ask is, am I going to leave that $2 million in the trust, which is fine, and pay a premium every year by writing a check from the trust account to the insurance companies? That's option 1. Leave the $2 million in the trust, write a check every year to the insurance company. Or should I just have the $2 million go right away from the trust to the insurance company? The answer is probably option 1, because if I do option 2, if I give the $2 million right away to the insurance company, I will create what's called a Modified Endowment Contract. What that means is that that policy will have disadvantages from an income tax point of view. If I want to pull money out of a Modified Endowment Contract, take a distribution from the cash value at some point, it may be taxable, may even be subject to a tax penalty. I don't want that. So the general recommendation is leave the money in the trust, write a check out each year from the trust to the insurance company. Yes, if I leave the money in the trust, I'll have probably investment income. I might have to file a tax return, but it's a much better result than having a MEC. Also, another reason for leaving it in the trust, think about it. If I pay $2 million into the trust and I write a check out in the first year for $100,000 of premium, and let's say the death benefit is $10 million. Sometimes clients die unexpectedly. Not everyone lives to the life expectancy of the insurance company mortality table. People die at all ages for all reasons, and we don't know when that's going to happen. So if the client dies early, unexpectedly, let's say he paid the first premium of $100,000 and the trust gets $10 million a year later, if the person died after a year, the trust would have $10 million of insurance, but it would also have $1.9 million left from the original $2 million gift. So the trust would get a total of $11.9 million. If I gave the $2 million originally to the insurance company, it's gone. I get $10 million of death benefit, no problem, but the $2 million is now in the hands of the insurance company. I'm not getting that back. So the better result is to leave the money in the trust. Now, the reason I'm focusing on gift tax valuation today is because there was a tax court case earlier this year, Di Matteo, it's in the slides, the actual citation. So here's the situation. The client comes to you and they have a variety of life insurance policies, and they are the owner, the client is the owner of the policy. It's not uncommon, right? And the only way, of course, you're going to discover that is by collecting all the policies or working with the insurance agent to collect all the policies and identifying who the owner is. By the way, if you want to know who the owner of an insurance policy is, don't ask the client. They don't remember what they did. I'm not being critical. I mean, we all, we go through many changes in our lifetime. We rewrite our wills. We change the ownership of a policy. We change the beneficiary. Things change. Do we remember what we did 10 years ago, 20 years ago, 15 years ago? So really the best way to find out who the owner and beneficiary of every policy, and I think it's a very important thing to do for a client initially when you're doing the planning, is you get a written confirmation by email or fax or whatever from the company. The owner of this policy number XYZ is such and such. Now we know where we stand, and if it's owned by the client, we want to get that policy out of their estate. And to remove it from their estate, they have to survive 3 years, but they usually do. It's out of their estate. And also, the other big advantage of trusts is such an important thing we sometimes forget, is the creditor protection for the beneficiaries. So it's not only out of the estate of the client, but that client's beneficiaries, children, grandchildren, whomever they might be, are protected. If that one of those children, for example, becomes a doctor and is sued in a malpractice lawsuit, the insurance values in the trust are not going to be subject to the claims of a malpractice lawsuit. They're not going to be subject to the claims of bankruptcy. They're not going to be subject to the claims of a divorce settlement. So the trust is so valuable to protect the beneficiaries, not only to provide estate tax benefits, but to protect the beneficiaries. So we move the policy from the client to the trust. We make a gift, right? Assignment of the policy to the trust. It's a gift. What's the value of that gift? The value of that gift, in the case, let me give you some guidelines. If it's a term insurance policy with an annual renewable premium that changes each year, term insurance with a premium that goes up a little bit each year, which is uncommon today, but you have some of them, then the gift will be the value of the unearned premium for an annual renewable term policy. The other type of term insurance, which is much more common, is a level premium policy where you pay the same premium every year for 10, 20, 30 years. The value of that policy is not the unearned premium. You must get a Form 712 from the insurance company, which will tell you, believe it or not, that there is a reserve value for that policy, which is going to be significantly higher than the premium. So you must get a 712. By the way, general rule, get a 712 every time. Every time you're going to make a gift of a policy, call the insurance company and get a Form 712, which will tell you the value of that policy for gift purposes. In Di Matteo, Here we go, bottom of the slide. In Di Matteo, the client's advisor, I don't know why, but they decided not to use the reserve value as the value for the gift. They went to a life settlement company. That's a company that's in the business of buying insurance policies. Now, you could say that should be the fair market value, but the value that they came up with was much lower than the reserve value. They got examined by the IRS. IRS said, we don't like this, and they said that you have to use the reserve value. They went to tax court, they settled, but there was a deficiency of $4.29 million after settling. $4.29 million gift tax deficiency after they settled the case. The deficiency was larger, obviously, before they settled the case. So clearly, my advice to you is use the 712 reserve value. Don't start to use alternative methods when trying to value life insurance. I'm not a valuation expert. Nathan can talk more about this later, but that's the lesson I think we should learn from Di Matteo. Okay, now comes the very hot topic of the day. I mean, it's been around already since June, so it's not like it happened yesterday. It's been around for several months. Actually, this case has been around for several years. It went to the 8th Circuit, went to the Supreme Court. Very unusual for a life insurance buy-sell case to end up in the Supreme Court. I guess one of the obvious reasons is there was a conflict between different circuits about how you should do this thing, and we'll talk about the issues in a moment. But before we get into the issues of the Connelly case, let's just review the basic concept of buy-sell. By the way, the first thing I would say about buy-sell that's probably more important than Connelly is make sure your clients have one. If you have a client that has a closely held business with 2 or more shareholders, we're not talking about a family, but unrelated shareholders, make sure they have an agreement. If they don't have an agreement, then they're going to end up probably litigating the value of the business when one of those shareholders dies, because one family wants a high value, one family wants a low value, they won't agree, and they'll litigate. So do the agreement, you avoid that problem. That's probably the most practical takeaway message I could give you on buy-sell agreements, is they should have one. Now, there are 2 types. There's redemption and cross-purchase. In redemption, the company owns the insurance, assuming it's funded by insurance. The company pays the premium, and the company is going to redeem the stock when someone dies. In cross-purchase, the 2 shareholders own the insurance on, or 3 or whatever, own the insurance on each other, and when one shareholder dies, the other one buys out that interest with the insurance proceeds. So let's look at what happens in a redemption agreement. So that's, by the way, Connelly is on redemption, so that's where the issue is. Cross-purchase, nothing changed. It's redemption that got changed. And here's the redemption agreement. The business owns the policy, pays the premiums, and the 2 shareholders are subject to the agreement. Let's take a look at what happens when someone dies. A dies. Let's say the business has a value of $10 million. And let's say that each shareholder is equal, that A has $5 million and B has $5 million equity interest in the business. And that the company buys $5 million of insurance on A and $5 million of insurance on B, and A dies. Now, in the days before Connelly, the company would receive the $5 million of insurance, it would buy out A's interest for the $5 million, and that would be the end of the story. In the Supreme Court case of Connelly, actually in the 8th Circuit before that, here's what happened. The court said, wait a minute, we need to look at this carefully. When that business gets $5 million of insurance proceeds when A dies, the court said that the value of the business was increased from 10 million, was originally 10, 5 and 5. Now the 5 million of insurance comes in, and the court says the business value was increased to 15. Now, the taxpayer, the Connelly family said, yes, we agree, the business value was increased to 15, but the business has to use the 5 million to buy out A's estate, and that's an obligation or a liability that offsets the value of the insurance. Let me just say it again, I want to be clear. Business was originally valued at 10. 5 million of insurance comes in, value goes up to 15. Taxpayer says, obligation to buy out, is an obligation that reduces that, or offsets that increase, brings it back down to 10. Court said, no, we don't buy that. This is not a corporate liability. We do not recognize it as a corporate liability. I'm not a lawyer. I'm not going to try to analyze it. Lou and the valuation, and Nathan can talk about this later. I'm just going to tell you what the result is. The result is the court said the business value was increased from 10 to 15, and there is no offset for the redemption obligation. End of story. 9 judges in the Supreme Court agreed, so we have nowhere else to go on this unless the Congress changes the law, which I doubt. So the business is now 15. So what happens? A's share is 50% of 15. That's 7.5. So A gets a step up in basis from whatever value he had before to 7.5, but the estate doesn't get 7.5. The estate gets $5 million of insurance. So the estate is selling $7.5 million of stock in exchange for $5 million of insurance, and that creates a capital loss of $2.5 million. Now that capital loss may be useful, not necessarily a bad thing. The problem is not so much the capital loss, the problem is the estate tax valuation of the stock jumped from 5 to 7.5. Now, today, that may not be a problem. We have a huge exemption. But if the business was worth $30 million or $40 million, and the guy had a $20 million interest in the company and received $20 million of insurance, and therefore increased the value by 10, that's a big problem. So the estate tax valuation is the problem that has been created by Connelly, and the message is that we need, obviously, to go back to our clients, which is a good thing for us and a good thing for our clients, to review these structures, and maybe we have to change the cross-purchase. Now, in what time? I still have a few minutes. Okay. Now, here's another very important how much time do I have, Beth? 15? Oh, that's good news. I didn't know I had 15. I'll slow down. Okay. Here's another very important point, and I want you to write this down, please. The solution, or one of the solutions, is you switch from a redemption to a cross-purchase. Because in a cross-purchase agreement, the company's not involved. The company's not redeeming the stock. It's just the 2 shareholders. If it was Lou and me, we'd own insurance on each other. The company is not involved. So when we get the insurance proceeds, the company value is not changed because the company never got the insurance. The company is out of the equation. So the answer is often, we're going to change the cross-purchase. Here's what I want you to write down. Please watch out for transfer for value. It's the worst thing that can happen to a life insurance policy. Of all the tax mistakes that someone can make, transfer value is the worst possible nightmare because it makes the death benefit subject to income tax. Insurance is always income tax free unless you cause transfer for value. Now, what is it? What is transfer value? Transfer value means I transfer a policy to another person in exchange for value, like money or something else. Why is there a rule which says if I transfer a policy to somebody else and I get back money, that my death benefit is going to lose its fantastic income tax-free treatment? Because the IRS, actually it was a very good reason, they did not want people to buy and sell policies and trade them like a commodity and try to make a profit from the sale of a policy. I know we have sales of policies today, but the original intent was not to encourage that activity. So they said, if you're going to sell a policy to somebody, we're going to penalize you by taking away the tax-free treatment of the death benefit. Now, why would that be relevant in this situation? If I have a redemption agreement, Lou and I have a business, the business owns the policies, we say we don't want the Connelly problem. So we're going to take the policies out of the business. The policy on my life will be owned by Lou, and the policy on Lou's life will be owned by me. So now we have a cross-purchase. We don't have the Connelly problem. Here's the problem. When the policy on my life is transferred to Lou and vice versa, the corporation is relieved of two obligations. It no longer is obliged to pay premiums under the buy-sell, and it is no longer obliged to redeem the stock when someone dies. The famous case, Monroe versus Patterson, it's been around a long time, IRS 1. It's a transfer for value. When the policies are transferred out of the business, even though the business doesn't get any money, it's relieved of these obligations. That's called valuable consideration. The business is relieved of those obligations. That's valuable consideration, and that's a transfer value. So if that, and by the way, how would this get picked up? On any significant estate, the estate tax will be, the estate will be examined, and on the estate tax return, you have a schedule of every insurance policy on the life of the decedent. By the way, even those policies not includable in the estate have to be listed. Every policy on the life of the decedent has to be listed on that schedule so that the buy-sell policy will be listed. Any sharp, not insurance agent, any sharp IRS agent is going to look at every policy. If they see a transfer, they'll look at that transfer to see if there was a transfer for value. So you must avoid transfer for value. Here's my most practical point on transfer for value. Anytime a client is about to transfer a policy, forget about Connelly, for any reason, anytime a client is about to transfer a policy to someone, tell them, hold the paperwork, don't send the papers into the insurance company, let me or someone in my office check and make sure we are not causing a transfer of value. Very, very important to avoid that problem. Where's Beth? How much time do I have? Oh, wow, this is good. Okay, so let's now go on. So the message on buy-sell, 3 points really, right? 3 points. Make sure your clients have a buy-sell. You know, before you get caught up with all these fancy cases, make sure they have a buy-sell. Number 2, if they have a redemption buy-sell, you may need to change it to a cross-purchase. And please remember not to trigger a transfer for value whenever policies are being moved from anyone to anyone. Always, always check and make sure there is no kind of consideration that's going to cause transfer of value. Okay, let's take a look. Just want to remind people of the value of doing split dollar, especially today, because interest rates came up in the last 2 years. You know, one of the ways that we finance the purchase of life insurance in estate planning is we want to try to avoid large gifts, because if I have a client who buys a policy and it's a significant premium and that premium is gifted from the client to the trust, that's going to be a gift that has to be reported. If that client has already used their gift tax exemption, their lifetime exemption, and they also are using their annual exclusions for other purposes, then that premium becomes a taxable gift, which I want to avoid. So there are 2 techniques that generally are used to finance life insurance to avoid a large gift. One is borrowing money to pay the premium, and the other is split dollar. Now, borrowing money today is more expensive. In 2020, it was virtually 0. Now it's not 0. It could be 5, 6, 7% interest on the loan. So split dollar is an attractive alternative to reduce the value of the gift. Split dollar is basically an agreement between 2 different parties to purchase a life insurance policy. And the IRS has a set of regulations on split dollar, and this slide is based exactly on those regulations. And based on those regulations for what's called economic benefit split dollar, you can reduce the gift dramatically based on IRS tables, because the IRS says that the premium payment is not a gift. The premium payment is an investment by the company in the insurance, because it's eventually going to get back money for that investment. We're not going to treat it like a gift. We're going to treat it as an economic benefit, and the value here is only $4,000 out of a $100,000 premium. I know I went through that very quickly. My message today is not to try to explain to you the mechanics of split dollar. That would take hours. My message today is simply to alert you to make a mental note or to write down for yourself, if I have a client that's about to buy a large amount of insurance where there could be taxable gifts, think about doing split dollar if they have a closely held business, because the business is a wonderful way to finance that insurance without creating gifts. Again, split dollar, think about it, when a client has a closely held business, they're about to buy insurance, you want to avoid large gifts, split dollar is worth looking at. One more thing about split dollar and about any corporate insurance arrangement. Remember that the premium payments are generally not deductible for income tax purposes. Remember that the life insurance premiums are generally not deductible. I gave you 3 examples on the slide where they are, and those are legitimate deductions, the retirement plan, the group term, and the bonus. But when you get outside those 3, be very careful. You know, again, if you've been around for 20 or 30 years in the insurance business, we've seen a lot of different proposals where someone says, I can get you tax-deductible life insurance, and they end up in tax court with penalties. You don't want that type of a problem. There is, by the way, recently a particular proposal called the Restricted Property Trust. Already we've had 2 cases on this where the deductions were disallowed. So please be careful. Okay, please be careful with regard to life insurance. Generally not going to be deductible. Don't try to get away with things that are going to cause your clients problems. Okay, so this is good time. So let's take a look at the takeaway messages. We talked about financial strength. Remember, parachutes and cardiac surgeons, same principle applies to life insurance. Number 2, the conversion option, very important for term insurance. Number 3, when you're pre-funding insurance with a large gift, you want to avoid the Modified Endowment Contract, so you leave the money in the trust and you pay premiums from the trust every year. You don't give that $2 million or whatever the gift is right away to the insurance company. Whenever you're transferring a policy from the client to a trust and you need the value of that gift, get Form 712 from the insurance company. Don't play around with alternative methods because you may get into trouble. But I will defer to Nathan later on. He's really the expert on that subject. Number 5, we talked about changing from redemption to cross-purchase. Please remember to avoid the transfer of value problem, very important. Oh, by the way, I said there was a transfer value problem. How do you avoid it? I didn't talk about that. You make sure that your shareholders are partners in a separate partnership. If they have real estate owned in a partnership and they are partners in that partnership, that's an automatic exemption from transfer of value. That's one of the key ways of avoiding transfer of value. Number 6, we talked about split dollar to reduce gifts. And also, and last point is that premiums are generally not deductible. Okay, that's it. Thank you so much.
Lee, before you step off, and you did leave a little bit of time, so we have a few minutes if anyone has a question. I have a question. We have a case we're working on right now, which is the Connelly case, and it's a company that has corporate owned about $20 million on each shareholder of life insurance. We're moving it out. We're looking at creating, and we've had this conversation before, we are looking at moving it out, and we're creating a partnership to own the life insurance. And I know you are a Mass Mutual agent, and I know the home office at Mass Mutual is not terribly fond of that solution. What would be the way to structure it? Do you look for a separate partnership, or do you think you can create a limited liability company as a partnership just to own the policy?
The IRS has told us in the past that if we form a partnership simply to avoid transfer of value, for example, in life insurance, they're not giving us an automatic approval for that exception. So it's really better if you have a partnership that's formed for a business purpose other than simply owning the insurance. So if, for example, you have investments or real estate or something else like that that can be owned by the partnership or the LLC, again, I prefer a partnership because we have established law on partnership as an exception. LLC can be taxed like a partnership, so it should work, but I think a partnership generally is safer, and if it's formed for a different or independent business purpose, you generally will be protected.
Perfect. Other questions? Yes. Existing policies, yes. Question is, go ahead.
I didn't know. I don't.
When you're, go ahead.
Oh, I think when you say transfer value, are you applying that the existing policy?
Yes.
That you want to move it to LLP to avoid the
The
inclusion?
the transfer for value problem is not when we transfer it to the LLP or LLC, because when you transfer a policy to a partnership, you are automatically protected from transfer for value. That's one of the exceptions. The question or the problem with transfer for value is when you transfer it to another person, like in the example I gave with Lou and I as shareholders. If the policy was transferred from the company to Lou and to me, and I now own a policy on Lou, he owns a policy on me, a transfer to the individual can create transfer of value. But my more important thing, what I want you to remember from today, rather than trying to remember all the different rules, it's too much to do in one day, just make this your general rule. If any client says to you, I'm going to change the ownership of my policy and transfer it to XYZ, whatever, whoever it might be, whether it's a person, a partnership, just say, hold the paperwork, let me check this transaction when I get back to my office and see if there's any problem with transfer of value. That way you'll protect your client. Any transfer.
But if it is a gift, if you're simply taking an existing contract and transferring it into a trust as a gift, you don't have a transfer for value rule, but you have a 3-year inclusionary rule.
Well, except, let me give you another situation, which I would say any transfer, because when you make a gift of a policy, if it's got a loan against it, you'll have potentially a transfer of value, because the loan is then transferred with the policy, so the original owner is relieved of that debt, and that becomes a valuable consideration. I would say any transfer of any policy at any time to anyone, just make sure that they don't do it without you checking carefully before the transfer is completed. It's such a bad problem. You want to avoid it all the time.
Other questions? So one of the things that Lee brought up was how many of your clients walk in the door knowing exactly who the owner is on the policy, who the beneficiary is on the policy, what the terms of the policy are, and this applies to virtually any insurance and almost any asset. So finding out what those things are. I had the experience personally, Lee, of a confluence of the cardiac surgeon and my term life insurance policy. About 8 years ago, I went in for a routine test, and a routine test turned into more tests, and by the end of the day, I was admitted to the hospital for open heart surgery. And the first thing I did was sent to my office and said, send me all my life insurance policies and all my assets, because I needed to check and verify that everything was in order. Thank goodness it was. A quintuple bypass later, I had to convert. I was in year 19 of a 20-year term policy and had a conversion option, so I had to convert my term policy to a permanent policy because, lo and behold, I was uninsurable. So you never know when life is going to happen in this realm. So keeping on top of that is very, very important.